right, so everyone, welcome to the Multifamily Live meetup. We have the honor and privilege tonight of having a high-level operator, speaker, and accomplished real estate investor, Alina Trigub, who I'll let her speak to her own bio, but has done some really incredible things in the multifamily space and is going to talk to us tonight about questions that we should be asking, both as LPs evaluating deals with sponsors, and then also, which is more common, I think, in this group, us as sponsors asking LPs who are looking to partner with us on deals.
Awesome.
With that, I'll leave it up to you, Alina.
Thank you, Mark. I appreciate that warm introductions. It's great to see everybody. I see quite a few familiar faces and names, so good to see you folks. I prepared a small presentation that I'm going to share with you. And I want to tell you up front, don't worry about scrambling to write the questions that I'm going to go over, because if you want to have a full list of questions, either for operators or for investors, I'll give you 2 links at the end where you can grab full list for each yourself without writing it down. With that, let me start sharing my screen. Can everyone see my screen?
Yep, we can see it.
Good. So can anyone remember what they had for breakfast today? Anything good and delicious? Anyone wants to shout?
Oatmeal.
Awesome. That's pretty healthy. That's a good way to start New Year. That's awesome.
Yeah.
Excellent. Well, I'll let you think it over. With that in mind, let's move to the beautiful disclaimer that I have to put out. It's not. It's only for educational purposes. We're not selling anything, just to educate folks and give them the information that they're looking to learn. A little bit about myself. So my journey started in this country almost 30 years ago when my mom and I immigrated to the United States. And I was at the point deciding what kind of career I want to pursue, what kind of degree I want to pursue. Someone told me, hey, you're good with numbers, you'd be good as an accountant. So I took that on and got my degree in accounting. I started my professional career as a tax person, tried public accounting, didn't really like it, and thought that I should move into private, which I did, but that kind of confirmed my assumption. I hated that career altogether. So I left the taxes and accounting field and moved into the world of information technology, where I had a successful 20 plus years career and have done a lot of different things. But mainly my roles have always been around being the liaison between 2 worlds, the world of business and the world of technology, kind of help the 2 worlds communicate. And while doing that, my career was progressing, my husband's career was progressing, and so were our income and the tax brackets. And as a former tax accountant, I kept to always think about finding ways to minimize taxes. And real estate kept coming up as one of the best ways to shelter your income and minimize tax implications. Just like most of you, I live in New Jersey. It's one of the highest tax states. So I tried to search for properties locally, but the numbers would never make sense to me. So I decided to go out of state. And while searching for that out-of-state property, I came across this strategy called syndication, and it seemed interesting. So I decided to dig deeper and research it. And after doing some research, I realized that this was a good way for me to enter into the world of real estate while still working full-time and raising kids. First, syndication was a really heart-wrenching experience. I did a ton of research, spoke with a bunch of folks that were LPs, passive investors, limited partners, as they called. And then I finally decided to take the plunge and invest. And there was a funny story along the lines, which if you want to remind me later, I can tell you, which actually helped me make the move and invest in this first syndication. It was really stressful, but I put my emotions aside and moved forward. And after that, the snowball effect happened. There came the second, third, fourth, and so forth. And after investing in a bunch of syndications and realizing all the benefits of passive investing, building wealth, saving on taxes, and so forth, I started talking to my friends and colleagues and realized that almost no one ever heard of syndications. And I took it close to heart. And out of this, the idea of my own company was born. So that's how SAMO Financial was born, with the idea of helping other people build wealth passively, save on taxes, and diversify their portfolio into something outside of Wall Street, directly into real estate. And so while I was building my company and working my job, COVID obviously happened. And during COVID, my position, just like for many others, was eliminated. I decided to no longer look for another job and continue building and growing my own company. And while doing that, last year, I was actually introduced by a mutual friend to Mike Zlotnik. He is the fund manager and CEO for the TF Management Group. You see the background that I have, the company in my background. TF Management Group is a real estate fund management company. We build funds based on specific investment goals. So each of our funds, which is based on a fund-to-fund structure, which entails that we don't buy our own projects. We either co-GP or LP with other syndicators. So each of our funds has a specific investment goals, and typically these investment goals are aligned with investor goals. So I'll give you an example. There's an income fund, so it's typically for folks that are looking for the immediate passive income because they're retired or because that's their current lifestyle. So they would look closer and decide to invest in the income fund because it meets their investment objectives and so forth. So that's my story in a nutshell. And while I was going through this journey, I, of course, reached that, poured that, which made a huge impression on me. And when I later learned that there is a teenage version, I actually made my two kids read the book. And I thought nothing of it. I mean, they just read it because I forced them to. But then I was riding in a car with my son, and he was 11 at the time. And he was patiently listening to myself having a conversation with the investor. And when I hung up, my son turned to me and said, "Mom, you were talking about assets and liabilities with this guy." And I was taken back. I was shocked. I'm like, "How do you know?" And he said, "Well, remember you made us read that purple book." So my eyes lit up because I felt good. Something did sink in at the time that both him and his sister read the book. So that was really helpful. Enough about me. The topics that I'm going to be covering today really to cover what kind of questions you should be asking investors as the deal sponsor, syndicator, operator, whatever you want to call yourself, or the questions that you should ask sponsors as a passive investor or as an LP, limited partner. So we'll cover both. But let me start out by asking a few folks, how many of you had a situation where you've come to the closing table only realizing that you're short by, some thousands of dollars? Have you ever had that case? I see some folks nodding. What about how many of you had a case where you were negotiating with potential LP, you had a super lengthy conversation, answered a bunch of questions they asked, only to get to the point where at the stroke of midnight, they come back and tell you they're not going to move forward? Have I had that? Yeah, I see folks nodding. Okay, so we're on the same page here. Good. All real life case scenarios. So let me tell you the story about the guy. We'll call him Nick. Nick is a friend. We known each other for a number of years. Nick has been bugging to invest with me for a very long time. He owns an HVAC company, and finally, when a few years back, this opportunity to invest in about 300 units apartment complex in DFW Metro presented itself, I showed it to Nick, and we had a call with him and his wife where I answered a bunch of questions. And then he followed up with an email of about 20 more questions, which I dutifully answered. And then he said, send me the offering documents, which I did. He completed the subscription agreement. He completed the investor questionnaire. And then a few weeks go by, and then I sent him the wire instructions, and then nothing happened. I didn't get any feedback from him. And then a few more days of stress-inducing silence passed by, and here we are a few days before closing, and Nick comes back to me and says, you know what, Alina, I'm sorry, but my wife's family is having a problem, and I need to take the money that I committed to this project and give it to my wife's family. And I said, okay, no problem, I understand. But it left me in a difficult position. Here I was a week before closing without all of the funds needed to close. And I had to go scramble, find somebody who would be willing to fill in this gap, either through a short-term bridge loan or quickly find a new investor. I could have been annoyed with Nick. I mean, after all, he had committed and didn't follow through on his commitment, which was, after all, his fault. But on the other hand, there were a number of questions that I should have asked him. It probably would have assessed the fact that he was not a suitable candidate for this investment. Why? Because he only had $50,000 to invest, but he didn't have the cushion afterwards. That's what I overlooked. I did not ask that question. I never, ever want to take someone's last $50,000. Even if it's a perfect investment. I don't want to take their last $50,000 because it leaves them depleted, because it leaves them in an awkward position. If they have any emergency situation or need money immediately for their family, such funds must be easily accessible and liquid at all times. And I failed to ask the question. The fact that he backed out of the deal, it's just life, it happens. But I failed to find out about it before it happened. I could have determined beforehand that he was not a suitable candidate for this investment and eliminated both of our discomfort from the get-go. All too often, it's too easy to get caught up in the idea that we're selling something, and if we could just have investors say, yes, we're off and we're ready to go. When you're out there raising money, getting investors saying yes and commit to the project, isn't it the goal after all? So I was in an unfortunate position of having to go back to my investment partners and tell them, you know what, guys, I had an investor back out and we might not be able to close. It was embarrassing and humiliating. These folks were counting on me to deliver. So the failure to come through on that particular investment wasn't my fault. It was Nick's fault. But it was my responsibility. Those two words sound remarkably similar, but they have vastly different meanings. So when you're out there raising money, your goal is not just to raise money. Raising money is like finding that perfect pair of shoes. It doesn't matter that they're perfect. Let's go through a specific case. Let's say you're walking in a mall and you see this perfect pair of shoes in a window, and you go inside the store, and oh my God, it's your lucky day, they're on sale. So you go into the store, you ask for your size, you open the box, you unwrap the wrapping and try them on. To your disappointment, the shoes don't feel right when you put them on. So if the shoes don't fit, then you're not the buyer. It doesn't matter how beautiful they are or how deeply discounted they are. Yet when we're talking about investment, we get confused and we get into this weird zone. Investing is exactly like that pair of shoes. If the shoes don't fit, then you're not the buyer. If your goal is an investor and the goal of the project aren't perfectly aligned, and I don't mean close, I mean if they're not perfectly in perfect alignment, you're not a buyer for such investment. And if you're a deal sponsor and you're looking to sell the shoes, if they're not a perfect fit, don't take the money. It's exactly the same thing. So what's your job as a syndicator? Your job is to assess the fit. That means that you have to be asking a whole lot of questions. And if you're not asking these questions and assessing, then you're setting yourself up for failure. You're acting irresponsibly with your investors' money. I know it sounds harsh, but you have to do your homework. So let's cover some of the most important questions that you need to ask your investors. First of all, the size of the investment. So you assess that, first of all, what is the size of the investment? If, let's say, hypothetically, the minimum investment is 100 grand and the person only has 100 grand in liquid cash, it's probably not the right fit for them. I want someone that has at least 500,000 of liquidity to make a 100 grand investment. Therefore, in that case, it represents only 20% of their liquid holdings. If that 100,000 went to zero, it's not going to change their life drastically. It's not going to put them in a bad spot. If I'm taking someone else's last 100,000, it could be devastating for them. Now, mind you, we're obviously not in the habit of losing other people's money, but still, I don't want to take that risk, and I don't want them to take that risk. So the question becomes, what is the size of the investment, and is it the right fit for them in terms of their liquidity? Number two, what is the term of the investment? When they're going to need their money back. I have a friend who is an investor who always puts his money for a long term. Why? Because it's qualified money. He's still too young to tap into that. So he wants his investment to be tied up for at least 5 years or more. So I'm not going to offer him a 6-month flip. I have another guy who only invests in 6-month increments. So again, I'm not going to offer this guy something that's going to take 5 years. So always know what size shoes your investors wear and only bring them to try the right shoe size. So the question here is, what is the size of the investment and what is the term of the investment? Next, what is the risk? What is the risk of something bad thing coming true? By the way, the risk itself is not the whole question. The question is, what is the risk and what is the impact? You always have to look at those two things together. And when you look at those two things together combined, they always define safety. And overall, safety is the right factor or the right equation for that particular investor. So as you know, there is typically a direct correlation between the risk and reward. So while discussing with the investor the investment, you help to always ensure that they understand the risks involved in a particular investment, and what's more importantly, what are you doing as a deal sponsor to minimize such risks? Next one, what is the control structure? Some investors prefer to have control, others are happy to be passive investors. So if control structure does not match their particular interest, then just don't take the money. Next one, what are the tax consequences? People have their own individual tax situations. Some invest for depreciation, others want to invest to shelter money, and depreciation may not matter that much. So it really depends on what a particular investor is most interested in. It's not a question of whether it's a good investment, or the question is whether it's the right strategy for them. For example, I was talking to this investor that had over $1 million gain on his hands due to the sale of his business venture. His main concern was to minimize the tax hit and find a suitable investment to do so. While you may say, well, it's a good problem to have, it is for folks like him. But nevertheless, he's put a ton of sweat equity into this venture, and he did not want to end up losing a ton of cash by paying a high tax bill. So just keep in mind one thing. It's not your job to be their tax advisor. They have to hire professionals, but you still need to make the assessment. Next one, what is the rate of the return and what is the cash flow? Some people are investing because they need that recurring income. Other folks are investing because they'd rather defer cash flow and make the money in terms of the overall IRR, internal rate of return, putting together both long-term appreciation and the cash flow. Cash flow investors are typically different from the appreciation investors, and you have to make sure you understand the difference. For some investors, it may make sense to invest on the debt side, especially if they're putting qualified money, like self-directed IRA money in. For example, I have an investor who is a millennial. We'll call him Brad. Brad likes to travel because he's a digital nomad. So the most important thing for him is to receive a recurring income, cash flow. I have another investor, Valerie. She and her husband recently finished paying off for their kids' college education and now planning for their retirement. So the key for them is to build long-term wealth. So they are concerned more about long-term appreciation. And two people may have a completely different investment goal and yet be able to invest in the same project if you're offering different investment classes for them, where these investment classes are aligned with their investment goals. Many investors have a specific minimum in mind, and for them, time is the most precious commodity, not money. So they typically make larger investments. And if a private investor, for example, wants to make investments only in 5 million increments, and you have a project that needs 200,000, it doesn't make sense to present that project to him or her. Why? Because they're looking for much higher minimum. So don't waste their time. Some people are at a stage in their life where they made their money, they worked hard, and they want to put money to work, but they want it to be somewhat protected. They want it to be safe. So they don't want to go back and forth. They're not looking to earn the highest rate of return, but what they're looking first and foremost for is capital preservation. And increasingly so, if you're going to be talking to folks that are higher net worth individuals or family office representatives, you're going to discover that that is in fact the case for them. The higher the net worth, the less they worry about higher rate of returns, and the more they worry about capital preservation. Next question is, what about asking them about specific investment criteria? You can learn an awful lot about an investor by asking them these simple questions. Savvy investors will have a clear definition of their investment criteria. Why? Because they thought it through. They've done it multiple times, and they have defined not just one or two, but dozens of different variables that need to be met. If you're talking to unsophisticated investors, on the other hand, they're going to be much more wishy-washy. They may just tell you, oh, I just want to make money. Oh, I just want to have a high return. They're not going to be precise. Now, these kind of investors are sometimes much easier to bring on board, but they aren't necessarily always the best investors to have. The next important question to cover is the timing of the investment. Keep in mind, you cannot be asking investors for money today if you need them to wire it tomorrow. You need to allow at least 2 to 4 weeks on average for the conversations to happen, prepare to answer multiple emails, phone calls, answer their questions in person, and only after them have them commit. So patience is an absolute virtue in this case. You should also make sure that you discuss the security of your investments with your clients. While some investments, for instance, could be debt and can offer property as collateral. Other investments could, for instance, be secondary debt or mezzanine debt and have a second position and only come into play after the first position is paid off. Don't overlook the exit strategy of your investment either. Typically, more sophisticated investors want to know what they can expect at the end of the term. They want to know when they can expect at all or at least a portion of their capital back. So they want to know about any potential capital events that you're planning and what your plans with the exit as well. You want to be asking your investors about their investment philosophy. You want to ask them what other investments they've made in the past, which ones turned out well, which ones have not turned out well, and what they learned from that. And while it may be tempting to have your investors stand in front of you and say, yes, I'm ready to move forward and sign the offering documents, remember, it is always your responsibility. Now, I want to make something very, very clear. You're not your investor's CPA or financial advisors. They must hire these professionals to receive proper tax and financial guidance. However, it is your responsibility to assess where they stand financially. Do they have emergency funds set aside untouched? Are they coming to your investment with the funds that are specifically allocated for investing? And they have a full understanding that this investment is not FDIC insured and there are risks involved. All of these questions are super, super important. Let's now switch to the other side of the spectrum. Let me know if you as an investor want to invest, but not really sure like what questions to ask a sponsor or syndicator. Have you ever been in that position? Okay, I see some people nodding heads. What about, have you ever had a case where you invested and lost money through your investment? Okay, I see some people nodding. Okay. Now, these situations are possible to be avoided by simply asking deal sponsors the right questions. Let me tell you a story. It's my personal story. I'm obviously going to change the name and locations and everything for personal reasons. But let's call this operator David. He offered to invest with him in a small apartment complex in a beautiful small town with a great infrastructure, very strong job market, and good rentals demand. I spoke at length with him. We discussed his family, his career. We discussed the project. He even flew out to meet with me and other potential investors in person. Seemed like a great guy. His references checked out. Nothing seemed to be off balance. I took action and invested. What happened only a few short months after we closed is a completely separate story. But let me just say that I wish I had taken extra step and asked him for his financial position and asked him for other project that he managed and asked him whether the project that he manages in line with the project that he is buying right now, the project that I was investing with him. So with those few questions, I would have probably got the answers that would make me realize that I should not have moved forward with that investment. Excuse me. So what some operators miss to understand that a significant part of the operator in a syndication is to carry on fiduciary obligation to investors. What does fiduciary obligation entail? Fiduciary duty is a legal obligation of one party to act in the best interest of another. The obligated party is typically a fiduciary, that is someone entrusted with the care of money or the property. So if someone fails to perform their fiduciary duties, the red flags will be in their every investment? Have I dug deeper when I was evaluating investing with this guy and requested such financials for his other projects? I would have prevented losing on this investment. So allow me to reiterate some of the more important questions that need to be asked. When you are an operator talking to your investors, you have to ask them, what do they know about investing in syndications? What is the current financial position? Do they have emergency funds set aside? Are the funds they're looking to invest specifically set for investing in a syndication? Which means that if anything happens and these funds are lost, this will not drastically impact their financial position. When you're an investor looking to invest with a sponsor, some of the questions that you want to concentrate on are, what is the deal sponsor track record? Can you see the results of some of their past investments? Can you check on their references? Ask them if they had any failures. And believe me, only a fool will tell you that they had none. Now, failure does not automatically translate into loss. An example could be if they were going through a tough period with their investment and they had to bring a significant portion of their own capital into the deal just to stay afloat. It has happened in the last downturns, and a lot of operators had pretty high vacancies and they were trying to stay afloat and keep the property moving. Bottom line, a lot of people learn from their own mistakes, but no one marches ahead without making no mistakes whatsoever, at least at the very beginning of their career. So again, the smart operators will be fully transparent, and they will share with you not only their mistakes, but also what they learned from their mistakes and how they were able to mitigate similar risks down the road with their future investments. So at this point, I would like to make sure that you guys learned something from this presentation. And if you took anything from today's talk, I want to make sure that you do not repeat the same mistakes that I did, because you know what? If I knew these questions to ask when I was on either side of the syndication, I wouldn't have made these mistakes. I needed to ask those questions, and so should you. Thank you.
Awesome presentation, Alina. Really, really tons of value, tons of gems. One thing that occurred to me in you talking about some of these questions is some of the same considerations that you have on the LP side if you're looking to invest in a deal are some of the same considerations that you should have as a sponsor. You want to know that that counterparty across the table from you is in a good, solid financial position, that they can, withstand, should things turn sideways. Also, their experience, whether it's you're an LP investing with the investor, with the sponsor, you want to know, obviously, they have the track record, they have the knowledge, but also, the parallel to that is the sponsor. They want to know that whoever's investing with them, understands what the risks that they're taking, the unique risks that are represented in real estate. So that was a real aha moment for me. So thanks for that.
Thank you, Mark. Thank you.
Yeah. So if anybody has any questions, feel free to, either throw them in the chat or raise your hand and we'll unmute you, or, we'll go from there.
Hey, Alina, I have a kind of a question for you. I got invited to raise some money for an opportunity recently, and the structure of the deal was so that the sponsors of the GP wouldn't receive any payouts until around the third year. And so I walked just because I was concerned that the other sponsors would not focus on that deal as soon as they were involved in a deal where they wouldn't, where they were actually getting paid on another deal because they weren't getting paid on this particular deal. What would your approach be to that? Have you ever been invited to raise money for a deal where the sponsors didn't get paid till the third year?
No, this is definitely the first time, but let me ask you this. Have you asked the question to the sponsor? What was the reasoning? Why did they structure the deal in such a way that they wouldn't be paid until year 3?
So the way that what was told to me was that my connect is somebody that's very helpful, and he helps out a lot of newer sponsors. And so it was the first deal for these particular sponsors, and so they just wanted to make their returns more attractive to the investors. But as I looked at the pitch deck, I was super concerned that they would lose interest in managing the asset properly because they weren't getting paid.
I'm in complete agreement with you, and I can tell you that I've never seen this kind of structure. And what I can tell you from personal experience, so I was a GP on a deal where the deal was not performing, and it was due to, unfortunately, partnering up with the wrong people. So what we did in that deal is, first of all, we hired an attorney and legally removed the wrong partner from the deal. And then we started working on the deal. But even though the agreement dictated the asset management fee, we did not take any of it because the deal was not performing. The investors were not paid. And we made sure that the investors were paid out first before the GPs were compensated. So that's a reverse to what you were saying. And in our case, we decided to forego the asset management fee in favor of the investors because we felt obligated to returning investors all their money, and they actually made a small gain on that investment as well. But in general, what I've seen newer operators do is create the waterfall structure that's more favorable towards the investors, where investors get maybe 80% of the deal and the operators get 20% on the back end. They still take asset management fee, but maybe it's not 2%, maybe it's 0.5% or 1%. It's on the smaller side. But I'm in complete agreement with you that for the sponsor to perform, they have to be compensated for their work. Now, if the project is not performing, that's a separate story, as I mentioned earlier. But there should be a compensation structure that compensates each and every person from the get-go. Great question.
And there's some situations where, like if you implement a pref, there's some delinquencies in payout till like year 2 or 3, until stabilization. So I wonder if there's situations like that. But you do see some instances where the sponsors are waiving the asset or the acquisition fee, just to kind of increase the returns to investors and make deals work from an investor's perspective. But sacrifices like that, they create a misalignment of interest. I saw one deal where they waived every single fee possible, but they changed the equity from 80-20 to 70-30. So I guess everyone could kind of enjoy more upside. But yeah, my concern there is misalignment of interest. To your points.
Absolutely, definitely. What other questions do you have, guys?
So I can jump in here with one. So from the sponsor standpoint, this is something that we're constantly trying to divine or trying to pull out of the investor, is understanding where their financial position is. And you talked a lot about suitability, and I absolutely agree there. In fact, the 5 times their liquidity rule that you had mentioned there, that you want to know that if they're investing $100,000, they have at least $500,000 liquidity. I really like that. Going to probably use that going forward. But I was just curious, how do you, I guess, at what point do you broach the subject of, okay, what does your financial position look like? Obviously, early on, somebody might be a little bit hesitant to share that information, but I guess at what point do you really broach that subject?
When you have more than one conversation with the investor, the first one is to get a sense whether they even qualify. For example, at TF Management, we only work with accredited investors. And for us, it's always critical to make sure that we don't waste other people's time and our time. So that's the first and foremost question that I ask people, if they're accredited or not. And then we talk on a high level what TF Management does and what the investor wants in general, what they're looking for. If there is some alignment, if there is potential to work together, then at the next conversation, we move into deeper questions. I ask them about their personal position, financial position, their long-term plans, A lot of folks are setting up plans to get out of their W-2 jobs and become financially independent, and maybe either work part-time or not work at all much earlier than 67, 69, and so forth. So for a lot of folks, it's important to plan ahead, whether it's 5, 10, or 15 years or more ahead, and prepare for that time when they would be able to take the leap and leave off of their passive investment. So we move into those conversations. It's also a lot easier to talk to the folks that are warm introductions, and at TF Management we have a lot of those. If folks are warm introductions, someone send them to you, then by all means you can jump into more personal questions as early as first conversation, because when they're warm, they're pre-positioned to have that conversation because they were already warmed up or prepared by their referral to talk about the subject.
Thanks.
Does that help?
Absolutely.
Any other questions that you guys have?
Alina.
Go.
Thank you. Hi, Alina. Question I had for you. I missed the first couple of minutes, so you may have mentioned this. I know your background is in financial accounting, but in the beginning, when you were kind of getting started, what were some ways that you were networking or connecting with new potential investors, and how have you continued that down the line?
Great question. So I started pre-COVID, and I think it was a huge advantage. I networked a lot. I went to a ton of local meetups. I started two on my own. They used to be in person. One was in the city, one was in New Jersey. I also traveled to a ton of conferences. Someone mentioned earlier that they're going to Hunter Thompson conference, so that's a great conference for investors. Best Ever is coming up, a lot of other conferences. So I kept meeting and networking with people without having any specific purpose in mind. I kept meeting a ton of great people and networking, talking, because what it comes down to is not just exchanging business cards. And by the way, now it's not even a thing. I mean, nobody's using hard cards. It's either a virtual card or just a text, or you slide it with your phone. But before, it was obviously exchanging your contact information and establishing and building those relationships one person at a time. So whether it was a quick phone call or quick email or a text, but always staying in touch with those folks, regardless whether you see someone as a potential partner, friend, or potential investor. It's absolutely critical to stay on top of their mind and continue building the relationship. Does that answer your question, Gary?
Yes, thank you.
Sure. Any other questions?
I have a question about evaluating the financial position for a sponsor when you're an LP. Kind of similar to my question earlier. Can you just out and out just ask a sponsor, hey, can I see your, what net worth, your financial, your liquidity, things like that? Or how would you, put the question to them?
Yeah, that's more of a sensitive question. I mean, you can ask about the track record. You can ask for audited financial statements if they have some. You can ask for specific details of the past projects, and they should definitely be able to share that. What I did at the beginning, at least, when I was checking out different sponsors and didn't know them, I kept not only checking their references, but also checking their background. And this one sponsor that I was specifically targeting to start investing with, so he kind of gave me his bio. I went ahead and I checked his school, I checked his prior experience to make sure that that's exactly what he did. And so the funny story that I mentioned earlier that I was going to tell you guys, he, by accident, this was, I guess, pre-MailChimp times, a long time ago, pre-distribution list times, he sent an email to all his potential investors, and instead of BCCing us, he CC'd everybody. I took advantage of that, and I sent an email to every single person on the list and asked them whether they have invested with the sponsor before. 2 people responded. One of them ended up being a close friend for many years. We're still very close friends. But essentially, those 2 people responded and said that, yes, in fact, they worked with him, they invested with him, and he's a great operator. And that made me pull the trigger. I mean, it literally, his mistake made me move forward with him and invest. And was really happy with that first investment. Turned out to be a great one. But yeah, sometimes you have to watch out for those small things that can trigger unexpected results.
Good point. So that's for references. Thanks.
Sure.
Hey, Alina, do you have any other, I mean, one of the books that I love to refer to is The Hands-Off Investor by Brian Burke for interrogating a potential sponsor. But do you have any other recommendations?
I have book recommendations. Are you asking specifically for books that would give you a list of questions to ask sponsors?
Yeah, I mean, I have lots of investor interface background, but
Sure.
I have some money that I need to start placing, and usually I'm just curious for other questions and stuff.
Sure. Yeah. Let me do this. So I promised you the 2 lists. I'm just gonna place both lists in the chat. One is a list of questions to ask investors. The other one is a list of questions to ask operators. Feel free to grab them both. I don't know any books that would give you the interrogation strategy, but I think this list will give you a good head start. And typically, what happens is, as you start asking questions, it becomes a conversation, and depending on the answers that you get, you come up with other questions. Let's say you're talking about XYZ investment, and the operator says that, well, this investment is very different from this last one that we did before, where we lost a ton of money. Here we go. Ask them. So how did you lose a ton of money? What exactly happened? You hear them talk about this, and as they talk about it, if they don't mention the lessons learned, then ask them, what are you doing this time differently to make sure you don't repeat the same mistakes? Does that make sense? So while you may see, you may have 5 questions, those 5 questions may turn out to be 25 or 12. It doesn't matter how many questions you have, as long as you get the answers that give you a good foundation to make a decision whether this is the right sponsor that you want to invest with. What's very critical is to ensure that the strategy they're implementing, the professional approach, is in complete alignment with your approach, and you feel confident in their ability to execute on a project. Does that help, Con?
Yeah.
Good. Awesome.
Any other questions from the audience?
Mark, while we're waiting for questions, can I share my contact information?
Oh, yeah, absolutely. Yeah, please do.
Let me share the screen again. Folks, feel free to ask your questions in the meantime. Here's my contact information. You can find me on many other social media platforms, but I use LinkedIn the most, so it's easier to find me, or through my business website, business email, alina@samofinancial.com.
All right, so if we don't have any other questions, just want to thank Alina for presenting on this awesome topic. I know I'll go back to this quote that I've heard, I believe it was Tony Robbins. He said, successful people ask better questions, and as a result, they get better answers. And I think that's definitely true when you're in the position of either an LP evaluating a sponsor to invest with, or as a sponsor evaluating whether or not to partner with an LP on a given deal. So thanks so much for those nuggets that you dropped tonight.
My pleasure. Always a pleasure. Folks, feel free to reach out. I don't have a list of books that would help you to interrogate sponsors, but if anyone is looking for books in general to deepen their knowledge of real estate or apartments, I do have a whole library, and I'm going to post link in the chat with a bunch of books. While it has a ton of real estate books, there is a ton of books on personal development, including Tony Robbins, Hal Elrod, and many other authors. So feel free to tap. These are all the books, not all the books that I read, but these are all the books that I personally read and recommend.
Awesome. Providing value at the very end. Thanks again, Alina. Really appreciate it.
My pleasure. My pleasure. Thank you very much for having me, Mark. It's
Absolutely.
great to be
And
here.
yeah, no, absolutely. Our pleasure. And for anybody that wants to stick around, we're going to do what we normally do. We're going to have a breakout session here for networking. You might as well meet here. We're all kind of like-minded people, whether it be people looking to invest. And you can use those questions that Alina provided to LPs, or those of us who are looking to be more active on the GP side. So without further ado, we'll go ahead and do the breakout rooms.